Music has abruptly stopped in the bond market. On the firing line was one of oldest and well-connected investment banking firm JM Financial for a sharp yet common practice. In this video, let's investigate to understand why the RBI pulled the plug on JM Financial. Let's understand what are the different ways for a corporate to raise funds. Apart from the equity market, there is this debt market, which is a lucrative way of corporates to raise funds. Bonds can be issued either through a public route or the private placement route. The private placement route is for pre-selected investors or institutes like fund houses, pension funds, and insurers. While it is a very simple way, it comes at a cost because these fund houses are very finicky about the price and they insist on an AA plus rating of the corporate. In contrast, the public issues are more complex in nature as they have to adhere to a lot of regulatory rules. However, these are an easier way for the corporate to raise funds as the prices can be chosen to benefit the corporates. Here also, majority could be retail and HNI investors. What did JM Financial do? The corporate, in this case, Pyramid Industries, wanted to raise funds. JM Financial was their broker who helped them raise funds through the public issue route. JM Financial funded a group of mule investors by giving them the required funds on an advance basis so that they could purchase the public issue. So, the public issue was attractively priced. Let's assume it is priced at 90 per bond, just as an example. So, what these investors did is they immediately sold them at a profit, say 92, to a group company of JM Financial, a subsidiary. This subsidiary in turn sold them at a loss, let's say 87, to fund houses and insurers. So the corporate actually in effect raised funds from institutional investors. So the whole event looked like a public issue, but the funds were actually given by institutional investors. So it was actually masquerading as a public issue. The HNI investors got their money. 92 minus 90 was the profit. JM Financial also made a lot of money in spite of their subsidiary selling it as a loss because the interest they made from the loans given to the HNI investors, the brokerage charged to the corporate ensured that they made a neat profit in spite of the JM Financial subsidiaries selling it as a loss. For the corporate, it was a good way of raising money. So why do corporates like Pyramid Industries prefer the public issue? Pretty simple. Because an private placement is difficult for corporates unless they have an AA plus rating. Secondly, these private placement investors demand better returns and they are tough negotiators. By using this route of public issue, the corporate sends out a signal that they can raise debt at a fine rate and in turn claim a diversified investor base. Now, why did JM Financial did this? Of course, JM can argue that no rule was broken. Financing of public issues is legal. No law stopped retail investors from selling in minutes, or a group firm offloading papers at a loss. But for the regulator, the message was simple. The spirit of regulation was trampled upon. JM Financial did this because it could take credit for pulling off a public issue. The earnings from brokerage and interest of the loans given to the mule investors was decent enough money and offset the loss of the JM Financial subsidiary. So this tells you the saga of the investment banking firm JM Financial. In fact, there are quite a few brokerage firms which indulge in such a practice. The coming days, months would see a reduction of bond IPOs, public issues, because of the wrap of the Reserve Bank of India. Thank you.